This is Al Brooks, and this is my price action trading course. The current module has to do with protective stops for scalping. Remember, a scalp means a small profit target, and usually traders don't allow pullbacks, except maybe a small pullback. To take a scalp trade, the trader's equation still must be positive. If you're going for a small profit, you need a high probability trade. The cardinal rule of all trading is to make sure that the reward is at least as big as the risk, even with a scalp. A scalp requires a high probability setup, and you can use a stop that is no bigger than your goal. And also, once you figure out what your stop has to be, you have to make sure that your goal is at least as big as your stop. Once the market gets close to your target, most traders move the stop to break even. For example, let's say the market's within a tick or two of hitting your profit target, and your stop is now 10 ticks away. Most traders will not allow that to happen. They'll move their stop to break even, and if they get stopped out, they don't worry about it. So to risk 10 ticks to make 2 ticks, you have to be 90% certain of it happening, which in general is unlikely. And if you're less certain than 90%, the trader's equation would be negative and you'd lose money. So once the market gets within 2 or 3 ticks of the target, let's say you're risking 10 ticks, if the market comes to within 2 ticks of the target, most traders would start thinking about moving their protective stop to break even. For stops, traders can use a money stop. For example, let's say they're buying IBM, they might risk $1, a fixed number of ticks, or they can use a price action stop based upon the price action. So let's say they sell below a strong bear signal bar, they may place a protective stop 1 tick above the high of the bar. So for a money stop and a bear trend, you want to risk a certain number of ticks or points above your entry price. So for a small stock, a small price stock like Cisco, Bank of America, maybe you want to risk 10 or 20 cents from your entry price. And the E-mini, with the E-mini trading around, let's say 1400 or so, and the average daily range of about 10 points or so, you might want to risk 2 points. If you do choose to use a 2-point stop in the E-mini, you need to go for a profit target that's at least 2 points. Even in a scalp, you always want your profit goal to be at least as big as your risk. If you're trading a $100 stock and you're using a 50-cent stop, you have to go for a profit target of at least 50 cents, at least as big as your risk. And what about a price action stop based upon the bars? Okay, that's what a price action stop is. You base it on what's going on with the chart. For example, if you're buying in a bull and you have a bull reversal bar for your signal bar, you would consider placing a stop 1 tick below the signal, 1 tick below the low of the signal bar. You may also use a measured move target, based upon either the height of the signal bar or some gap above the signal bar. That most traders do not do that. Most traders would use a price action stop based upon the signal bar, not based upon a measured move. So most traders either use a fixed stop a number of ticks away, or they'll base their stop on the signal bar. Let's say the signal bar is 8 ticks tall. The risk is 10 ticks, right? If you bought 1 tick above the top of the signal bar, okay, and you risked to 1 tick below the signal bar, the total risk is 10 ticks. And then you should go for a profit target of about 10 ticks. You always want your reward at least as big as your stop. So if your risk is 10 ticks, you go for at least 10 ticks of profit. And if you're using a wide stop based on a measured move, you have to use a wider profit target at least as big as your risk. Here's an example of a money stop for scalpers. let's say the traders bought the close of this bar. At this point, the market, in the minds of most traders, is always in long. They might use a money stop 2 points below. If they did, their minimum target would be a move equal to their stop, which would be right here. Let's talk about the same trade, and this time let's say traders bought this close and they used to stop at 1 tick below their entry bar. This is the bar that made the market always in long. It's a breakout above the high of the day and well above this high. The close of the bar is above the high of the day and way above the high of the prior bar. So traders might put a stop below the low of the bar. If they did that, again, they need a reward at least as big as their risk, so they would go for a profit target up here. And you can see that the market went sideways up here, so a lot of traders did in fact take profits at around that measured move target. Okay, once the market gets close to your goal, if you're scalping, you want to move your stop to break even. So if it gets to within 10 or 20% of your target, you'd move your stop to break even. Okay, you want the reward at least as big as your risk, and once you determine your stop, you make sure to go for a reward equal to your stop. So if we have this strong bear reversal bar here, and you shorted at the moving average in this bear trend or trading range, at the moment it's both a bear trend forming lower lows and highs, and it's also a trading range. So if you shorted this bear bar at the moving average, your initial stop is above its high, and you entered right here, you could go for a risk equal to its reward. After you had this very strong bear bar, you could then go back and look at your actual risk, which was 1 tick above the high of this bar, and you could adjust your target based on your actual risk. So your actual risk now at the end of this bear bar is up here. Your entry price is here. You could go for a measured move, which would be right around the close of that bear bar. So as that bear bar is forming, a lot of traders would say, oh, my actual risk is probably above the high of the bar. My reward now is equal to my actual risk. I'll take profits. And that's what happened, and that's why the market reversed up there. A lot of traders scalped out of their shorts based on their actual risk. Okay, over here, if you bought above, let's say you bought above the high of this bear bar, thinking it's a higher low major trend reversal, your initial stop is below the low of the signal bar. Your initial target would be a measured move up right here. And that is the end of the module on protective stops for scalps.